Today's news is sponsored by American Retirement Systems, providing competitive solutions for agents and advisors. For more information, please visit AmericanRetirementSystems.com. Now for today's headlines. Consumer spending and incomes remained flat in June, further evidence of a slow economic recovery, according to the Commerce Department. Spending increased just 0.1% in May, and June figures are expected to be comparable. Meanwhile, weak consumer spending contributed to an economic growth pace of just 2.4% during the second quarter, after a growth rate of 3.7% during the first quarter. In regulatory news, Federal Reserve officials are mulling a small but symbolic change in the management of its securities portfolio next week, as economic recovery continues to remain sluggish, according to the Wall Street Journal. On August 10th, Fed officials will consider whether to use cash received from mature mortgage bond holdings to purchase new mortgages or Treasury bonds, rather than allowing the portfolio to decrease gradually, as it is likely to do in the upcoming months. Fed Chairman Ben Bernanke recently listed the purchase of more assets as one of several options for the central bank when asked what steps could be taken to boost economic growth. The Fed's $2.3 trillion portfolio has nearly tripled in size since 2007. The purchase of new bonds with cash from maturing bonds would be a sign to the public that the Fed is attempting to bolster economic growth, the report said. Despite suffering massive declines in net asset values due to weak investment conditions and other effects of the financial markets, property casualty insurers have weathered the economic storm better than other sectors, according to a recent report by Standard & Poor's Corp. The report states that the P&C sector continues to be financially strong and remains relatively well positioned to deal with future investment volatility. Maintaining sufficient liquidity to pay claims will remain the main factor that insurers in the sector face when developing their investment strategies. According to the report, quote, "The asset portfolios of most P&C insurers are risk-averse and tend to be weighted in high-quality, investment-grade municipal, government, and corporate fixed income tables," unquote. The report also found that during the recent economic downturn, many P&C insurers lowered their exposure to equities, alternatives, and other more volatile classes. Finally, it found that while some insurers continue to have broad exposure to lower-rated or longer-duration investments, the holdings are considered modest compared with total invested assets and policyholders' surplus. For more on the industry, visit producersweb.com.